Hello everybody and welcome to the first quarterly update from Cambridge Partners for 2019. I'm Scott Rainey, I'm an advisor here at Cambridge Partners. I'm looking forward to taking you through the returns for the first quarter, looking back a little bit as well, explaining what that means and where it's come from and what it might mean for moving forward. So, moving on to the first slide that I'm going to walk through. Now, as you might see, this one references 2018. Now, the reason I've done that is it's really important to think about where we've come from when we're thinking about where we're going to go. So, I've titled this chart, The Growth of a Dollar to 31 December 2018. There's a chance I may have mistitled that, because if you look at the chart, you can see that most of the lines go down. So, I've started with the bad news, which means it can only go up from here. So that's nice. Now, the reason that things went fairly poorly in markets for the 2018 final quarter are multivariate. President Trump, as you might expect, played a reasonable part. Now, he presided over a federal government shutdown. Markets didn't like that. He also presided over the beginning of a trade and tariff war with China. Didn't like that either. In the meantime, we also had Brexit uncertainty. We still do, but I'm going to come back to that. All of that meant that markets had a negative quarter to end 2018. Not just negative, but quite substantially negative. In the baby blue there, which is international small companies, the value of a dollar invested at the start of the quarter would have gone down to about 80 cents as at the end of the quarter. That's a negative 20% return. Really poor. But what does all that mean? It's about context. And if I think about the context here, overall, a mix of 50-50 of shares and property and fixed interest and cash would have fallen about 5%. Now that's not just bad, but actually it's one of the worst quarters in the last 10 years. And in fact, the December month was the worst month for developed markets since 1931. Not a great start to the 2019 year, if that's what we're talking about, and certainly not a great end to the 2018 year. So, what about the year to December 2018? Because the quarter's interesting, but there's not necessarily a lot of informational power in it. Now, if we look at this, I concede, very messy slide, we can see that actually things were tracking along really nicely, right up until the end of September. Then October and November and December happened. All of them pretty poor. Actually, up to the end of September, returns for the calendar year were looking pretty good, around about 5% for that 50-50 mix of shares and property and cash and fixed interest. By the end of the December quarter, which was around about -5%, -6% for that mix of assets, actually the total year had fallen to around about -1%. So, 2018 wasn't a great deal of good news for investors. So that's where we've come from. All in all, fairly bad news. So the March quarter can't possibly have been as bad as that, could it? Short answer, no. March has been a very, very good start to the year. So we had a terrible December, but actually the March quarter has been positive for that same 50-50 mix, shares and property and cash and fixed interest, of around about 6.5%. A little bit more if you had some exposure to small companies and value companies. Wow, that's a big turnaround. So what's been the reason for that? Well, we think about the news flow over the same time period. The US federal government shutdown's ended. That's a good sign. The US Federal Reserve has changed its tune. Now, towards the end of last year, the Federal Reserve was very much talking about increasing interest rates, which tends to slow down the economy, slow down markets, and send a negative signal. It's reversed that signal. So it's now saying that it's not going to increase interest rates. It's going to continue to be accommodative. And that's actually reflected around the world. The European Central Bank, the Reserve Bank of Australia, the Reserve Bank of New Zealand, and China Inc., because that's probably the best way to think about it, have all delivered similar signals about easing monetary conditions. Now that means either decreasing interest rates, which they're talking about in Australia, and our Reserve Bank has certainly indicated as possible, or further easing of quantitative matters, such like creating more money, which is what the European Central Bank is looking at doing, or, in the case of China, looking to encourage borrowing. All of that creates additional liquidity, which puts more money into the system, which tends to drive up asset prices and be supportive of business in general. Markets like that. Now, I said earlier that I was going to mention Brexit again because that uncertainty hasn't been resolved. Hasn't seemed to matter. The March quarter has been really strong. One of the strongest quarters in the last 7 years. Now, notwithstanding the negative information that was in the news only 4 months ago, things have turned around markedly. What does that mean? Well, let's look at it in a broader context of the 12 months rather than just the 3 months. Again, a very messy slide. So this is the growth of a dollar for various asset classes from the start of April 2018 to the end of March 2019. And again, it looks like a really good story. What's interesting, and I mentioned the baby blue line earlier in this session when I was talking about small companies in an international context. Well, it was the worst during the December 2018 quarter. It's one of the best over the course of that full year. And that's interesting. But what it shows is that for this 12-month period, we've had one of both the worst and one of the best quarters in the last 7 years. But the overall return for the last 12 months for that 50-50 blend of property and shares and fixed interest and cash has been around about 7%. Now actually, that's around about the long run average for this mix of assets. It's exactly what we should expect on average over the long term. And that's interesting. But it's a really good quality of averages that we can have both a really good return and a really poor return and still get the average return. And the reason that that's instructive is that it can inform how we should react to both those really poor returns and the really good returns. Because if we responded precipitously to the bad news, we would sell. And that would result in us selling low, which is one half of a really good recipe to lose money. The other option would be if we reacted precipitously to the good news, we'd go ahead and buy. And actually that's the other half of the recipe. You buy high, you sell low, you lose money. That's why we don't react that way. So, what are the key takeaways from this brief session on market returns to 31 March 2019? Well, the average includes both good returns and bad returns. That's why I showed you the December quarter and the March quarter. A really poor return and a really good return because they actually matter, because they form part of the average as a whole. Unusually, in this case, they happen sequentially, but the average incorporates them both. Over the long term, the average return from a 50-50 mix of shares and property and cash and fixed interest would have delivered around about 7% per annum. That's almost exactly what the mix delivered last year, which incorporated both that really poor and that really good return. Never sell in bad markets. If you react emotionally to markets, you will suffer financially and probably emotionally. Really key to try and avoid it. Have a plan. A good plan will incorporate negative returns. It will incorporate bad markets. It will anticipate that these things will happen, and that can give us a framework with how to deal with it. If we know that bad markets are going to happen and actually the plan still says we can be okay, then that'll give us a higher chance of sticking to it. And that's likely to give us a better outcome over time. So, if you think you need some help sticking to your plan, feel free to come in and talk to an advisor at Cambridge Partners. We'd be happy to help.